I just started on Friday.
Oh, good.
Yeah.
Good. Let's see if this thing works.
So you're from California too, right?
Yeah, I'm from Berkeley.
From
right by
up
San
north,
Francisco.
Actually, I stayed up. I went to the Fox Theater in Oakland.
Yeah.
Yeah, I saw Bob Weir play up there.
Oh, that's
And
awesome.
I stayed at it was in Berkeley, I forgot the hotel, but it's right on the
The Claremont,
baby.
the
It's
White Hotel, right?
yeah,
along there.
yeah, right along there.
I
Yeah.
used to live right next to it. And
Really?
my buddy was like a member of it. So it was just like every single day after school, I also looked like a sibling. So I'd just like say I was his brother
Oh,
and just go in. We just like steam sauna every day after school.
That's so sick. When did you leave there?
When I went out to college in Boulder, so that was like 5 or 6 years ago.
Okay. So I was there in 2016.
Okay, gotcha.
How old are you? 23, 22,
25.
25,
Yeah. Oh yeah.
24.
Okay.
But I'll be 25 next month.
There you go. Yeah, I just turned 25.
You guys are young. Young
96,
pups.
96.
96. Yeah.
Dang.
No pups. Yeah, no pups either.
It's the year of the rat, unfortunately.
Oh, that's the way to go, though, man.
Like everyone else, like, oh yeah, year of the dragon. I'm like, I'm year of the rat.
Ah, man,
Don't trust me.
All right, we're gonna get started. There are some people online watching via Zoom, so welcome. We're gonna jump right in and talk about mortgages and the mortgage process and all the things that are part of the mortgage process, right? Just a mortgage loan. And I mean, there's so much information. We're going to cover a lot. So, at the end of this, if your head's spinning, just let me know, and I can actually send you a copy of this.
Cool.
Some good information, right? It's a PowerPoint presentation, but if you want to go back and look at something, or if you have a question or something like that, just let me know, because there really are. There's a ton of information. So anyone watching on Zoom, if you have questions, I'll try to keep looking to see if we can answer those questions if you have any. So
Real quick, I think we generally sign into something, right? It's like a sign in.
yeah,
Trainings
yes. So don't forget, and let's do that.
at the end. Cool.
Yeah. So we're going to talk. Let's just jump into it. If we can get this to work here.
All right.
No, don't be sorry. We're just starting.
All
Come
right.
on in.
They say, don't be sorry, just be better.
We're talking mortgages today.
Okay.
In the basics. So if you have a basic understanding, great. If you don't know anything, great. If you know a lot, great. But we're going to talk about a lot of different things. So we want you to understand what a mortgage is. We want you to know the basics on how you get, someone approved, pre-approved. And of course, when you have a buyer, we want that process to be, we want it to be as easy and as smooth as possible, right? So we're going to talk about that as well, how we can make that process a good experience. So, any questions to start?
I'm sure we're gonna have some.
All right, okay.
What is a mortgage? That's a good place to start.
Does anyone know what a mortgage is?
The lead.
It's a lien, right? It is a lien, and it starts with a loan, right? It starts with a loan. We get a loan, and that lien, is secured through a promissory note. So yes, so we get a mortgage. The mortgage is completed. We go to the closing table, and then a financial security instrument, a promissory note is secured through a lien against the property. So a mortgage it is kind of like a stock certificate, where it can be sold and traded on the secondary market on Wall Street, which is kind of interesting, right? A mortgage, I would say, just because homes are becoming more expensive, that usually a 30-year loan is what people are doing just because of affordability, to keep their payments affordable, right? But we can do a 20-year, a 15-year, or a 10-year. We can do a 25-year actually. So, and man, I will tell you this, and we'll get into it, but if you can do a 15-year loan or a 20-year loan, it's actually awesome because you actually save so much money in interest. It's crazy. So
So normally when you're discussing, you know, the length of the loan or whatever, is that something that really we do, or is that something that?
we do.
That's something that you
Yeah,
guys do, right?
we will talk to the client, we'll look at their situation and we'll give them options. We'll say, hey, look, this is what a 30-year payment would look like. This is what a 25-year would look like. This is what a 10 or 15-year. And then depending on what they qualify for and where they want their payment is we kind of customize a plan best for them, right? So we're going to talk about if you're a buyer, if you're looking to buy a home and you need a mortgage, this is what you need to do, right? There's a few things, there's a handful of things that we need to do to get a mortgage. Number one, you got to have good credit. When I say good, it doesn't have to be perfect, but it also, you can't have bad credit, right? So yeah, you want to manage your credit, you know, leading up to that you know, buying a home, because the better, and we'll talk about that. We're going to go into to credit scores and why it's so important, but certainly, you know, that's probably at the top of the list, right? Credit, it's a big deal.
It's accountability, right?
Yeah. I mean, that's really the first thing that we look at. We take an application, right? We do an application, and then the first thing we look at is we jump right into that credit, and we want to look at the credit score, and then we look at the credit history to make sure there's nothing there that we need to understand and know about. But yeah, credit is important.
So, Jim, right?
Yes.
So let's say like right now, I was in the aerospace industry for 30 years.
Okay.
And now I switched. Now I'm a realtor. So now my history is like, really, I have no credit, right? It's like I'm starting from the beginning.
That's a great question, and we'll talk about that. But yes, the work history is important, and that is a classic. That is a perfect example as to why it's important. Because I'll tell you why, real quick, and we'll go into it more. But on a high level, the work history is important because, and it's more. It's we look at more at the type of income and how you earn it. Meaning, are you paid an hourly wage? Are you paid a salary? Do you get overtime? You know, is there overtime? Is there bonus income? Is there all kinds of different ways of getting paid? But for you, for example, you've become self-employed essentially, because even though you're working for a big real estate company, they pay you a commission. So that's a good question, because normally we want to see a 2-year work history of commissions.
Right.
So now that you're doing this and you don't have a paycheck, you don't have a W-2, you're gonna have a 1099, you don't have pay stubs. So it does change the game for you a little bit. And we do need you. So you need to go through 2 years and be able to file 2 years of tax returns showing a history of commissions.
Before I can really go and even go buy a car.
I think the car thing you could.
Okay.
Mortgages is a little bit more substantial, a little bit more intense as it relates to, you know, verifying that. Cars, credit cards, all that's a little different.
So a career change is a big risk then?
It is if you're going
As far as the
from,
loan goes, I guess.
it is if you're going from salary or, you know, an hourly wage to commissions.
Gotcha.
That's where it's a
Okay,
big deal.
So if you're changing careers from one annual salary to another annual salary.
No
you're
big
probably
deal.
fine. Okay.
Yeah. It's just if you go from one industry making a salary or an hourly wage to commissions,
Gotcha. Okay.
that's a big deal.
Yeah.
Huge deal. it's always good for a buyer to have a little bit of money, you know, if you can, you know, the goal, I mean, really is if you can put 20% down, then you avoid mortgage insurance, right? That's a big deal. But that's okay. I mean, you can put on an FHA loan, you can put 3.5% down. On a conventional loan, there's a 3% down program. The standard, the typical, what we normally see, just because 20% to avoid mortgage insurance is such a large down payment, we normally see like the 5% range, you know, 5 to 10%. A lot of people seem to have that saved up. But there's a conventional loan with 3% down. There's FHA with 3.5% down. USDA, if you're out, you know, outside the city, they do 100% financing. If you're a veteran, there's 100% financing. But it's always a good thing to have some money for an earnest money deposit, you know, home inspections and appraisals and things. So it's always good to have a little bit of money saved, and we'll go into that in more detail. Obviously, it's to save you time and making sure that you're working with someone that is capable of getting approved for a mortgage. It's always good to get someone pre-approved before they start going out, before you start spending time going out there and showing them homes.
Oh, real quick. So pre-qualification and pre-approval different or the same?
Yeah, that's a good question. Pre-qualification is a loan officer, like anyone at Inspiro, any of the loan officers. If we take an application, check credit, so we'll get all their information, fill out the application, we'll check their credit. The first thing that we do is we look at credit, we look at their income, and we have to analyze that. We got to look at that and say, okay, how are they getting paid? What do they do for a living? How are they getting paid? And we try to look at that really, you know, up front. Are they a school teacher and on a salary? Are they a doctor and on a salary? Or are they a car salesman making commissions? Are they a real estate agent making commissions? Are they in sales and make commissions? And so we're looking at that, and a pre-qualification is a loan officer looking at that quickly. I shouldn't say quickly, but looking at it and looking at the credit, looking at their work history, looking at their type of income, and then looking at their bank statements to see if they have any money for a down payment, and then being able to say, okay, here is what they qualify for. And yes, they are pre-qualified because I have looked at the application, I've checked their credit. I know they have a history of making money, and this is how they make their money. And then we can send out a pre-qualification letter. That is one way of doing it. Probably a better way of doing it, which takes a little bit more time and energy and effort on the mortgage company's part, is taking that application, checking the credit, looking at everything, but then saying, hey, you need to upload into our system. I want to see your pay stubs. I want to see your W-2s. I want to see your tax returns. I want to see your bank statements. I want you to upload those now. And we're going to package that together, and we're going to have our underwriter look at it. Not a loan officer, an actual underwriter, processor and underwriter look at that, review it, and approve it. So then,
I'm sorry.
go ahead.
So it's not until it goes to the underwriter, you're not really pre-approved then.
Right. That's correct. So there's a lot of ways of doing it. And a lot of mortgage companies do it. There's different styles in the way they go about that. Inspiro decided this year that we really, on any buyer, we really want to get them pre-approved.
So if somebody comes and says, oh, I'm already pre-qualified, really is not really telling us anything.
It's not really telling you anything until
they might as well have done nothing.
right. Just say that, hey, that's great. I understand. Can you talk to someone I know, a mortgage company I know, and just or you could call that lender and say, hey, what have you done? Okay, you're pre-qualified. What's the loan officer's name and number? I want to call them and just say, hey, tell me what you've done with these guys. Did you just do an application and check credit? Have you looked at their income? Has the underwriter approved it yet? That's just something to be aware of. Let's go through these quickly. This is the mortgage language. This is our world. This is this is mortgage jargon. This is once you kind of understand all of these terms, then you can say, hey, I really know what a mortgage is all about. And I'm just going to go through them quickly. If you have questions, let me know. Loan to value. That loan to value basically means how much money are you using for a down payment? What is the down payment? What is your down payment? That's the loan to value. Real easy. But in the mortgage world, that's a big deal because all of the loan products are based on the loan to value. How much money are they putting down, right? APR is the government created the APR years and years ago, which is just kind of a tool for a buyer to compare mortgage companies and their fees. PMI versus MIP is different type. There are two different types of mortgage insurance. Private mortgage insurance is if you don't put 20% down, you have to pay PMI. You have to pay mortgage insurance, right?
Okay.
Mortgage insurance premium is tied to an FHA loan where regardless of your down payment, you have to finance some mortgage insurance premium into an FHA loan. Your debt to income ratios are huge. That's a huge part of the equation. Your debt to income ratios. That basically tells us what your buyers qualify for, and we come up with that debt to income ratio based on the home value, the home price, the sales price. It's based on their down payment, the loan amount, the interest rate, property taxes and insurance. And then it also, we factor in any monthly debts that they pay, any credit card payments, any student loan payments, any car payments. That's all factored in to the debt to income ratio that we have to analyze.
Going back to the PMI, the 20% or whatever.
Yeah.
Is that based off the appraisal or is that based off the?
Wow, that's a really good question. You're talking this
Right.
one? Yeah. So it's based on the loan to value. It's based on the loan to value and which is based off of the sales price or the appraised value, whichever is less.
Whichever is less.
Yeah. Yeah. Hazard, homeowners insurance, hazard insurance, that's just insurance to protect people's homes. But you have to have it when you buy a home. You have to have insurance. You've heard points or discount points. Points are typically used nowadays to buy your rate down. So if today's rate is 3%, but you want 2.5%, then you're gonna have to pay points, and it's based off of the loan amount. So it could be 1 point, 2 point, 3 points. It just depends on where you want your interest rate to be. An ARM, an adjustable rate mortgage, that we don't do them very often anymore. Interest rates, fixed rates have been so low for so long that we just typically do fixed rates now. Historically, there's been times where the adjustable rate mortgages were lower than fixed rates by a huge spread. So at that point, then we will look at an ARM for somebody if it makes sense. But right now, the market conditions are such that you might as well just do a 30-year fixed or a 20-year fixed or 25-year fixed because the rates are so low. LE and CD, those are just standard loan estimates and closing disclosures, which play a big role in the process on our end, on the mortgage side. That's a big deal. Sometimes some lenders, we don't charge origination fees. That's just, sometimes you'll have a mortgage company that will charge an origination fee upfront. But we don't. Escrow. The escrow account is basically an account that we put together. The loan is structured as such that part of your payment includes your property taxes and insurance. That's what an escrow account is, and that ties into the whole process. You know, most people, I would say 95, 96, 97, 98% of people just have an escrow account that takes care of their property taxes and homeowners insurance on a monthly and annual basis. You know, locking a rate, the the mortgage market rate is changing every day. Rates change every day. So right now they've been low. Rates have been low for all through COVID. You know, we've all been anticipating rates to go up a little bit, but right now locking is pretty straightforward. There's not a lot of stress because rates have been relatively low. What can happen at times is if the market goes crazy and rates start going up and you have a buyer wanting to buy, it can be a little stressful. So we have to manage that, you know, accordingly, because it can get a little stressful. I mean, every little rate, every 1/8% is a big deal. So PITI, you'll hear that a lot. What's my PITI? What's my payment? Essentially, is what someone's paying. What they're saying there. The PITI is your principal and interest, taxes, and insurance. That's everything included, you know, in your payment, and mortgage insurance, which says insurance, but we'll talk about FHA and VA loans. They're great loans. They're government loans. We'll talk more about that. We're going to go into all this. I probably spent too much time on this, but so conventional loans. I would say that conventional loans, probably we do the most, you know, if there's a product we do the most, it's a conventional loan. Conventional loan typically means you have to have pretty good credit and that you have a down payment. And that's what it boils down to. There are loan limits. So each county is a little different. So we have to, on a conventional loan, the first thing that we do is we make sure that their loan amount is within the guidelines. We have to look at that closely. But that you know, a conventional loan is kind of the standard loan. That's what everyone, for the most part, that's where we start. If we don't do a conventional loan, we're probably going to look at FHA. An FHA loan only requires 3.5% down. And an FHA, the big thing between a conventional and FHA, what it really boils down to are two things. Number one, the credit score. That'll help us determine whether we do a conventional or FHA loan. Number two are their debt ratios.
Which one's easier?
They're both easy. They're both easy, but if you have a client that really wants a home, but their debt ratios are just a little too high, we're probably going to look at FHA. Just because they can qualify for a little bit more home. Their debt ratios can be a little higher on FHA. And that's really the only reason. If we can do a conventional loan for someone, that's where we really want to put them. And we'll talk about this a little bit more, and I'll tell you why, is because if you do an FHA loan, the mortgage insurance is going to be tied to that loan for as long as you have the loan. So if you keep the loan for 30 years, you're paying mortgage insurance until the very last payment. On a conventional loan, we can remove that mortgage insurance once they hit that 20%, that sweet spot, once they have that equity. So if they only put 5% down, but over 3 or 4 years, the home appreciates in value, they can always get that mortgage insurance removed. So that's the big deal between those two. VA, it's awesome. VA loans are great for veterans.
Guaranteed.
Yep, 0% down, no money down. It's a great loan. Rates are low. It's a good loan. Jumbo loans. So here in Utah, there are a couple of counties, Summit County, Salt Lake County, believe it or not, for some strange reason, Tooele County, they'll go up a little bit higher on the loan amount, but for the most part, you know, if you're above that, then you're going into a jumbo loan.
Do you know why it's that exact number? Like why it wouldn't just be 550K as opposed to, I don't know, it just seems kind of random.
It's the government.
Okay.
It's a government. They do it every year, right around Thanksgiving time. They launch, they send out the new loan limits
Gotcha.
and they do it. Yeah, it's a weird,
So it's always changing.
every year, once a year it changes.
So
Yeah,
if it's less than that, then it doesn't qualify for a jumbo loan.
correct.
Or do I have it backwards?
Yeah, higher, if it's higher. If it's higher than that number, then you're gonna, so conventional goes up to 548. So if you're above 548, you're gonna go into jumbo.
Gotcha. So how drastically does it change, or is it kind of just anything?
The two things that are different from a conventional loan to jumbo is typically you need a bigger down payment for jumbo.
Right.
And the interest rate is a little bit different. There's not a huge difference, you know,
Just dealing with more money.
yeah,
Yeah.
just a little bit more, a little bit higher interest rate on a jumbo loan
Gotcha.
and a little bit more money down required. Yeah. So back in the day, before the financial crisis, you guys have heard about, you may or may not have heard about subprime loans. Subprime loans were like the crazy, exotic, aggressive loans that people were doing before the financial crisis hit 2008. Those went away. They went away. Oh, I'd say about 5 years ago, they started coming back, and we call them non-QM loans. Basically, what it boils down to, there are some loans out there that are available, and if it makes sense, they're safe. They are safe. We can't really take advantage of anyone. Not that we would, but it's just the government has tried to protect people. So this product has come back out and it's available, but we just have to look at it if it makes sense, if the shoe fits.
Do they follow TILA laws?
Oh, yeah.
Yeah, okay, so that's all there.
Yeah. Basically what it boils down to, it goes back to, if you're self-employed and you write off all of your income with all of your deductions, with all of your expenses, and you're self-employed and you do not show any income on your taxes, there's a loan out there that what this non-QM will provide is a loan for that type of a person. And the bank will analyze your bank statements, and they'll look at your bank statements for the last 12 months. And if you show income, if you show deposits, they will average out. They have a kind of a formula. They'll say, okay, we can see you don't have any income on your taxes because either you don't claim it or you write it all off. So let's look at a bank statement loan. If we can see that you're making deposits, we'll average that income out. And that's basically what these non-QM loans are.
So could that be used, like, let's say like somebody like in my case where I switched
Yeah.
careers? Could that be one of the uses for it? Go with the
Yes,
bank statements?
Absolutely.
So it's not like I'm completely out of being able to buy a house.
Correct. Right.
Okay.
And the big thing there is, if a conventional rate is 3%, right? Jumbo may be 3.25% today. This non-QM, it's there, but it may be 4%. So the rate's going to be a little bit higher.
So, I mean, I guess say you're in like a situation where you don't necessarily have income, it's stagnant, but it's a large amount of money just sit, like say it's like a trust situation, you know, you inherited a certain amount of money. Would you still qualify for that loan just based on what is sitting in your bank account?
No,
You have to have sort of.
you have to have
Proof of income.
show some type of income.
Okay,
Yeah.
gotcha.
It's like monthly. income
Monthly.
coming in.
Yeah.
It was like Source Seasoned, and there's like a few other.
Yeah. I mean, definitely conventional VA, all of these are going to require income, monthly income. It's going to require you to source your down payments and, you know, money you have in the bank and all of that. Non-QM is really the only product out there that would allow you to use bank statements and not tax returns.
But you still have to prove that there is money coming in.
Yeah.
Gotcha.
Yep. We kind of touched on the fixed rate. Fixed rates are really, that's what everyone's doing. I mean, everyone does a fixed rate right now. I don't think we've done an adjustable rate mortgage in the last couple of years. It just doesn't make sense. We are in Spiro, and a lot of mortgage companies are Fannie Mae, Freddie Mac, and Ginnie Mae. We call them seller servicers, meaning we underwrite to their guidelines, and that's a big deal. That's we have control of the process. We underwrite downstairs, and that's a big deal.
So are you guys inspired? Are you guys underwriters? Or are you guys mortgage companies?
We're mortgage
Both.
companies, but we have in-house processing and underwriting. Yeah, we do it all. Yeah. So we're a mortgage company, mortgage bank, but we have processing and underwriting inside locally. Yeah. When you buy a home, you got to be aware there's certain things that you have to pay for, right? First of all, if you have a down payment, great. We got to verify it. Closing costs, typically the buyer's paying for them right now. The housing market's so crazy competitive that sellers typically don't want to pay for closing costs right now. It happens. I've seen it happen lately, but in generally speaking, most of the time right now, we're seeing buyers paying their closing costs, and you can ask the sellers to, just so you know, sellers can pay closing costs. Out-of-pocket costs, home inspection and appraisals typically have to be paid up front. Something that we do here at Inspiro is if we get one of your buyers under contract and we order the appraisal and we do the appraisal, some mortgage companies on a purchase, we're talking purchase transactions for buyers. Some mortgage companies require the appraisal cost to be paid up front. In Spiro, we don't have them paid up front. And if we do the appraisal and the loan doesn't work out for whatever reason, we're not going to go after your client for that $500 or $600 appraisal fee. What we're hoping is they come to us, they find another home, and we do go through that process again, and we eventually get them a mortgage. But just keep that in mind. Most mortgage companies, you have to pay that appraisal fee up front.
So that could be a good point then when you're trying to get people to qualify.
Totally.
To go with you, say, hey, you know what? These guys were doing an appraisal, and
If it doesn't work out, we're not gonna ask you for that money.
Okay.
We're just gonna hopefully come and find, if you find another home that works, we want to help you with that one too, right? I mean, and eventually get them into a mortgage.
Question
Yeah,
from the St. George area. Do you guys service down here? Do you guys have a branch down here?
that's a great question. We're working on that. We've been talking to some loan officers down there so we could hire someone to be in that St. George market. But so we don't currently have one, but we do business down there. All of our team, we're all licensed in Utah, which covers St. George. So, and technology is so good right now that if you have anybody that we can help you with, just let us know, and we can talk to them on the phone. We can do a Zoom call. We'll even drive down there if you want us to, until we have a loan officer that actually lives there and can service that office.
I would love to talk to you maybe about a loan officer that might be interested as well
Awesome. Let's
for this
talk.
area.
Perfect. Would love to chat with you. That would be great. Thank you.
Just let me know afterwards.
Hey, perfect. Thank you. So yeah, inspections and appraisals, that's a big deal. Some of these out-of-pocket expenses can be gifted. So, but it has to be gifted from a family member. And there's a form they have to fill out. It's a gift form. It just basically says, I'm giving this person money. It's a family member, and it doesn't have to be paid back. That's what the gift letter says. Pretty straightforward. And then, of course, the DPAs are down payment assistance programs. Down payment assistance programs. There's a couple of them out there. One of them is Utah Housing. Utah Housing has a cool product that allows a buyer to get into a home with little or no money out of pocket. They do have to have on Utah Housing, you really need to have a 660 credit score to really make it worth it. They are expensive. Utah Housing loans are expensive. So if you have the 660 score, it allows you to get a little bit of money to help pay for closing costs. So just keep that in mind. We'll go into Utah Housing. I think we're talking about it. If not, let's.
It's like almost like another loan though, huh?
Yeah, different type of loan. It's subsidized by the state of Utah. They finance a second mortgage, so they don't have to have there's no down payment essentially, but their fees are much more expensive.
So is a rural loan considered a DPA?
No,
Okay,
no, USDA.
okay.
Okay, here we go. This goes into credit. Let's talk about credit for a minute. Credit is one of those things. It's like the first thing that we look at, and we look at the credit score. That's the first thing that we look at, but we do also analyze the credit to see if there's anything within the last 12 months that may be a question mark for the underwriter. We want to know if there's been any 30-day late payments. We want to know if there's been any collection or judgment accounts or those types of things. But really, it's the credit score. If their credit score, well, we can, by looking at that credit score right away, we'll say, okay, right away, we know we should have a deal. We should be able to help these people, just knowing what the credit score is, right? So this little formula right here just helps you understand how the credit score is generated. 35% of your credit score is generated on your payment history. If you make your payments on time, there's a good chance that your credit score is going to be high. But with that said, the next thing impacts your score almost as much as your payment history, and that's your balances. What are the balances on your credit cards? If you're maxed out on your credit cards and you've made your payments on time, that's good, but your credit score may suffer just a little bit because those are the two big ones, right? And then, of course, how long have you had your credit? How long have you been paying on your current mortgage, or how long have you been paying on the credit card, or how long have you been paying on that car loan? Makes up 15%. New credit and types of credit are lower at 10%. So the two big ones are these right here. So this kind of talks about, getting pre-approved versus getting pre-qualified, but let's just talk a little bit about it. I won't go into a lot of detail. We still have a ton of information to cover, but let's talk about debt to income ratios. And this is just, for example, if you have a client, a buyer that makes $10,000 a month, their payments, all of their payments, which would include a new mortgage payment, is $2,500 a month. Their debt ratio is 25%. Pretty straightforward. You take that $2,500, you divide it by 10,000, that gives you that 25%. So we like to see that would be considered, 25% would be considered a good low debt ratio, right? Which means they could go you know, if they wanted to, if someone was buying a home and they wanted to know what they could qualify for, you know, we could go, we want to keep it around 40. We can go up to 45. But just as a general rule, you know, being conservative, let's say 40%, but you can go up to 43, 44, 45%. And it's crazy, you guys, because we're talking $5,000 in a sales price, $10,000 in a sales price, $20,000 in a sales price, 50. It can all affect this debt ratio. I mean, a lot. So we're crunching numbers. We're looking at things closely because we want to know what they qualify for. It's a big deal.
So when you say the payments for $2,500, does that really make a difference too? You know how you were saying over here before, the types of credit. So let's say my house payment is $2,400 and then I only owe Jeremy $100. Would that be looked upon the same as if I have my credit cards are $2,400 and my house payment is $100?
Yeah.
Does that make sense?
Yeah, it would. That's a good question. And we would rely on the credit report. And the credit report is going back to all those, you know, how much credit you have, what are your balances, are you making your payments on time? That's more important than really.
So
anything
even
else.
if it was a 25% ratio, that will be. looked
Correct.
upon.
Yep.
Okay.
This is pretty straightforward. And it kind of goes back to what we were talking about being, you know, if you really just want to pre-qualify someone and see where they're at and see if we have, you know, just a quick look. Okay, let's get them pre-qualified. But if we really want to take that next step, and you guys, we launched this year, and I have to be honest, a lot of mortgage companies do this. I think we do it in a way that is a little bit more in depth, and we follow through. But getting someone pre-approved is a big deal, especially in this competitive market. So if we can get all of this stuff up front and get it to our underwriter and get them approved, we feel like it's a huge advantage to you as you go write up an offer, and you can tell the sellers, hey, these people are approved, right? We've got them approved. It's not just a pre-qualification, they are approved. Sorry about that.
No, you're good.
That's why we do it. That's why it's important, and we can do that for you. So, you know, if you can get someone through the process quickly, it's you have to get someone that's motivated, that's willing, that will get us their stuff quickly. You know, we got to get the bank statements, we got to get the pay stubs, we got to get the tax returns. Bless you. W-2s, pay stubs. We got to get all of that up front so we can really get them approved, fully approved up front. So you'd be surprised. Sometimes it's hard to get this stuff from people. They're busy, they have work, they have family stuff going on, they, you know, and for the most of the time people get it, you know, they know if we ask for this information, they know it's important, right? Sometimes it's hard. We would love to get someone pre-approved, get you the pre-approval letter, so you can go out and make an offer, right? And like I said, we really feel it's compelling. It's very compelling to tell a seller and hand them an approval letter saying, hey, these people are actually fully approved, so you know, they're good to go, right?
Do we need anything, like if I want to find out, I forgot his name. It's very easy for me to call and say, hey, I need to see if does Jeremy have a letter? Do I need to go through hoops to get that letter from you, or is that
Well,
pretty easy?
it's really easy if to get that letter, it's easy if the borrower is getting their information to us quickly. Meaning, so we have to do an application. Application is really cool. We have this really cool app. The app can be downloaded on their phone.
But me as an agent, I could say, hey, I'm working with Jeremy, can I get his pre-approval?
Oh, yeah.
That's
So long as
not
we've
a-
already done it.
Okay,
So long, if it's been done, and we'll send it to you. Heck yeah,
no problem.
no problem.
Okay.
It just takes, getting pre-qualified can be done literally in 30 minutes. Pre-qualified. It can be done, we do the application, check credit, that can be done quickly. But getting someone approved, it can take 2 or 3 days, it could take a week, depending on how fast they're getting us their tax returns and bank statements and W-2s and pay stubs. Takes a little bit longer, but it's probably worth, the extra time and energy to get it done. Yeah, those, the REPC and personal items can be included in the contract. The contract now, the new contract is written out really easy. I mean, it's pretty straightforward on personal items. We got to make sure there's an addendum if sellers are paying closing costs, got to get that dialed in. And the big thing for us is when we get a contract, we're looking right away. Okay, when is this loan closing? Because we got to get on this. We got to get the home inspection. You guys get the home inspection order. We got to get the appraisal ordered. We got to get moving, right? Especially if it's a 3-week close, 21 days. We got to get on this bad boy. We got to get going. So in the meantime, kind of the next step is as we get a contract, we're gonna start ordering everything. We're gonna get on it. We got to get going. We got to gather the information. We got to make sure that the interest rate is locked. We got to make sure that the borrowers, your buyers, are signing their application and disclosures. We're gonna get the appraisal order. We're gonna get with the title company, make sure that we got the title policy. We're going to order their insurance, their homeowners insurance. So we got to ask your buyers, okay, do you use State Farm? Do you use Farmers? Do you use Geico? Do you use, we got to get that dialed in. Third-party verifications. We have to get their verification of employments. We have to really jump on it, because there's a lot we have to do a lot of it goes unnoticed, and most people don't even realize all the things that we're doing on the back end. But we're on it. This is it's so important, right? To get off on the right foot, put our best foot forward, make sure the application credit, everything's dialed in, we get all their income and assets. And then once you have a contract, once we get a purchase contract, we're gonna go full steam ahead, and I hate to say it, we get crazy. We got to get crazy with it, because there's a lot of things that need to be done to ensure that we close on time.
She's gonna take a picture of that real quick so you can write it down.
Yeah.
That was a good idea.
Look.
Yeah.
Okay. We go through final underwriting at that point. If we have one of your buyers and we get them pre-approved up front, meaning we have an underwriter approve it up front, then this step is actually pretty dang easy, and it's actually makes it easier on our operations team, underwriting team. If we can get it all done up front, then once we get to underwriting, it's pretty easy for them, because they know we've already approved it. That approval is good for 60 days, by the way. After 60 days, then we're going to be asking for updated pay stubs and bank statements and things. But underwriter, this is their job. I mean, they're protecting everyone involved, right? They're looking at credit, they're looking at the collateral, which is the appraisal, making sure that we're compliant, that a family member is not selling it to a buyer and there's some weird things going on. They still look for that kind of stuff, I mean, it's pretty straightforward, but that's kind of what underwriting does. That's their job. They kind of give us the final green light, so to speak, the final approval, so we can then schedule a closing with your title company, right?
So pretty much on that writing, they're the investigators to see if there's any lies.
That's right.
If what I gave you is really. That's
True.
pretty much what it is.
They validate. Yes.
Okay, there we go. That's the word.
Yeah, they confirm, they validate that there's, and mortgage fraud still happens, but not like it did before the recession. But you can still, weird things still happen. So yeah, they are the investigator. They are making sure everything is good to go, and there's no fake W-2s or fake pay stubs, or that's their job. So this is a big deal. Let's talk about this closing. Once the loan is approved, fully approved, we get the green light, we're going to close this loan, right? From start to finish, we cannot close a loan within 7 days. You can't close a loan until the 8th business day, right? So just keep that in mind. It usually, doing a loan in a week, I guess you could do it. You'd have to have an appraisal waiver or get an appraisal the same day, kind of a thing. But just keep that in mind, because there's a timing. After the financial crisis, the government came out with a whole new closing process. So the big deal, the CD, we call it the CD, the closing disclosure. We can't close, your buyers cannot close on a loan until that closing disclosure has been signed. We can't issue the closing disclosure until that loan is fully approved, which means we've underwritten the appraisal, title, and everything. So once we get the green light to close, the final approval, we want to issue that. We want our closing team is going to send out an electronic closing disclosure, and we want those buyers to sign it, because that starts the 3-day waiting period. They cannot close until they've signed that closing disclosure, and we have to wait 3 days. So that's a big deal. That's right here. So once loan's approved, we can have them, we'll send out the CD. They have to wait 3 days before they can sign it. So that's why, we're working together on, okay, well, we already know, we have a REPC, and it says they're closing on September 29th. Well, we know, okay, and the loan was just approved today. So let's get that CD out today. We know we have plenty of time. We just got to make sure that they sign it, and it's been signed 3 days before we close. We could have the loan approved September 2nd, and it may not be closing till September 18th. So we have time, but we still want to get that CD out. We still want to get that 3-day waiting period out of the way and get that knocked out. We kind of, once we send out the closing documents to the title, we actually send the wire out the same time. We ask the buyers to wire their funds in. So everything's at the closing table, everything's at the with the title company. They've signed their closing disclosure. We know we have 3 days have gone by. We've sent out the closing docs and wire, and once that's all done, everything's dispersed. Money gets sent to the seller. Everyone's, the loan basically is completed and we're done. Title records, gets the loan recorded and buyers get their keys. That's kind of, it's all finalized, but keep in mind this tricky loan has to be approved. We got to get that closing disclosure out because they can't be signed. They can't sign if 3 days have not passed. So that's a big deal. Any questions?
Even after the 3 days and everything, when they're a settlement, they can still back out, right? And they just lose
Yeah.
they lose their earnest money.
Yeah,
They get set in concrete until closing.
that's correct. Yep, they can back out anytime up until the day that they sign. It's not official until they've signed. And once we've recorded, then it's done,
So even if they sign a settlement and they say the next day, they're like, oh, you know what do we do? Because it's not recorded yet, they can still. back
They
out.
probably could at that
Can't you
point.
sue for specific performance at that
You
point?
probably could.
Yeah.
Yeah, I mean, yeah, there's all kinds of weird things, yeah, that could happen, but yeah, then potential lawsuit or blah, 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 it could get ugly, but yeah, I mean, a buyer can back out. But the repercussions, at that point, who knows what could happen, but. So you get your keys, loan's done. It's funded, it's recorded, they've signed. And then they get their keys and we're done. Any questions? It's the process can be so simple, yet so complicated at times. Every buyer is in a different situation. Everyone has different credit scores, different employment and work history. Some people have money, some people don't, and our job is to find some options, to try to make the experience positive, smooth, easy. And it's hard sometimes. Sometimes we have to get a little crazy and figure out ways to make it work. And sometimes we have to ask for your help to, okay, what do let's talk through this. How can we make this work? This is what's happening. But we try to flush that all out at the beginning. If we can get that person pre-approved up front, it usually goes so much easier, so much smoother. And our job is to make you look good, because if you look good, then we look good. The client's happy. They're gonna refer family and friends. They're gonna come back to us again, and that's what we want. We want a client for life, really. I mean, that's our goal. And you've read that book, Raving Fans. It's how to create a wow experience. If you can create the wow experience, you're gonna have a raving fan. The raving fan is gonna refer family and friends, come back to you again. It's a client for life type of, it's the book's all about. That's what we try to do. And it's hard. But sometimes it goes, sometimes it's really easy, and then sometimes you have some challenges. Someone has some credit challenges. Someone may not, may have a funky work history. We got to figure out ways to get it done. And we never want to tell someone no. Look, if you can't do it right now because your credit or because you don't have tax returns, well, let's figure out, let's put together a game plan and figure it out.
So like now with it being a pretty hyper competitive market, if you don't have that extra, it was up to $100,000 over asking price, we saw in the last little bit. What are some tools you could do to help be a competitor in those bids with your finance?
Yeah, no, that's a great question. I think that we really were hyper focused on the Everest Advantage programs.
I've heard about that. Could you go over that again?
And that basically is what we've talked about. The Everest Advantage program is getting someone fully approved up front. Meaning, we do the application, check credit, but we verify everything. We get all their income, assets, and we verify everything up front, so we can issue you actually a mortgage approval letter. So so when you're going up against a cash offer, you can say, hey, look, this approval letter is as good as cash. It's better than cash because all we have to do is get the appraisal and title and we're done. We're closing. We can close in 2 weeks.
Yeah.
And
sometimes the issue is that person, in order to get that extra money, they gotta sell a home.
they
back
got to
to
sell a
California
home or
something.
they got to liquidate a 401k and they don't realize there's tax consequences. They're going to hit 30% on that 401k or
But-
that.
If they got cash, if they have cash in hand and they're like, 50 grand over, they're gonna be the most effective buyer.
Probably. I mean, if we're
Mostly,
being honest, yeah,
yeah.
it's tough, but you can leverage that Everest Advantage program, in certain cases for sure. But yeah, I mean, God, if someone has a suitcase full of 500,000, here's your money. It's hard to say no, right?
Yeah,
But anyways, yeah, Everest Advantage is cool. It's a good program.
Oh, stupid question, can you, let's say I have 250,000 in stocks and bonds, 401k, whatever. Can I say, okay, I have 250,000, now can you also get a loan for the rest of the amount, or is it one or the other?
So would you be using that 250 as a down payment?
Yes.
Yeah, so let's say you went to go buy a $600,000 or let's say $500,000 home. And you liquidate that money and you have that money, yeah, you can use it as a down payment and then we just finance the difference.
Is that something that we can use you guys for that too? Or is that total?
Oh,
separate?
oh no, I mean, heck, people have all kinds of different, they have money tied up in all different kinds of places. And we're working with them to try to figure that out. We're doing a loan right now where the guy liquidated a bunch of crypto, a lot of Bitcoin, and so he liquidated probably about $100,000 in Bitcoin. And we had to verify that. We had to show that in his crypto account, he had that money, he liquidated it and put it in his savings account. So if you're going to liquidate Bitcoin or liquidate an IRA, a 401k, whatever that is, we do have to verify it. We have to show that you have it. We have to get the statements. We have to show that you liquidated it and put it into your checking or savings account. But yeah, we'd use those. We do that all day long. We help people with that a lot.
Tim?
Hello?
Yes, this is Mariela. How are you?
Good.
I have a question for you. I know mobile homes or trailers, whatever you want to call it, are different. Can you explain what makes the difference? And you know that we have a lot of mobile homes here in St. George.
Yeah.
And
Yeah.
that kind of makes a little bit of a tricky situation with conventional loans. Most of them have to be cash. So can you explain that and give us options?
Yeah. The big thing with, you said mobile home, right?
Yes.
Yeah. So the biggest thing with mobile homes is if they're in a trailer park, we can't do it, unfortunately, because if they're renting the land the trailer's going to sit on, then really there's just no option in terms of conventional FHA, even USDA does not allow us to finance a home that they're leasing or renting the land, so to speak. So that's the biggest thing you have to be aware of. So if there's a manufactured home or a mobile home that has sitting on a lot, that they're buying the lot with that mobile home, and that mobile home is on a permanent foundation, we have to verify that it's on a permanent foundation. And certain times we have to send an inspector or someone out there to go underneath and take pictures to show that it's securely tied down onto the foundation. That's a big thing too. So the big thing is it has to be on a permanent foundation. And then a lot of mobile homes now are newer than I want to say it's 1978. But as long as those things are in place where you're buying the land and the home, it's on a permanent foundation, then you typically will have some options there in terms of conventional and FHA loans. And really any type of loan, but we have to look closely at that it's tied down. We have to look at the age and make sure that it makes sense. I hope that, and other than that, those are the big things.
Okay, sounds good. So are you aware of any other options, like any other, if somebody doesn't have like cash, because I've seen that most of them are cash.
Yeah, no, but if you wouldn't mind putting your name and phone number in, into the text, on the Zoom thing, and then I can follow up with you and give you, there are a couple of companies that I can refer you to that really, that they specialize in that mobile home type product.
Okay, sounds good. I'll do. Thank you.
Yeah.
Are you pronounced Inspiro or Inspiro?
Inspiro. I think it's a Greek word, inspiration, inspire. And that's how they came up with the names. Someone had a question. How do we get someone pre-approved? Just reach out to us, whether you're in California or in Utah. Just reach out to one of the loan officers and tell them you want to do the Everest Advantage program to get someone fully approved. Just let us know how we can help you.
Yeah, also Jay-Z, like I literally just emailed Phil Fiddler with the client's name, email, and number, and they sent them an application for them to fill out.
Yeah, just reach out to us. We're happy to. So technology is awesome. We have the app and they can download the app. They can fill out the application literally within 10 or 15 minutes. If someone wants to do an old school, face-to-face, we'll set that up. We'll set it up. We'll meet with them. And some people still want to shake someone's hand and get that trust factor going. That's great. But a lot of times technology is so convenient, so easy, they can fill it out and we're off to the races. Yeah. And the cool thing about the app is they can sign all of the paperwork electronically. They can upload their pay stubs, their W-2s, tax returns right into our system. So it literally gets uploaded right to our system, without having to fax it like old school fax or emailing it even, or whatever. So the technology is really cool. And anyways, just want to let you know. Our lender fees are pretty competitive. We're probably not the lowest, but we're not the highest. Our fees are $1,300, which is a processing and underwriting fee, which is basically pretty standard for the industry. Some lenders, they're just their lender fees, processing and underwriting. We've seen them close to $1,800 or $1,900. So we're right competitive, right at about $1,300.
And that's like, that's out of pocket for the buyer.
Well, that's part of the
lender.
closing costs.
Part of
Yes.
closing costs.
Yeah,
So we
that's-
could leverage that into the deal.
Yes.
Cool.
Okay. Thanks for coming.
Is that it?
That's it.
Yeah, you finished them quick, right?
I did it in an hour. We hustled.
Yeah.
And if anybody wants this emailed to them, just put your email in the chat and I'll email it to you.
You mean the?
I can email this. Yeah, this.
Oh, please.
Oh, yeah, we didn't have the.
I can email this to you.
I
Sorry.
think I'm better with
No,
it.
yeah, mix it.
Yeah, If you write it, you remember it better. So
I'll like to give you my email.
yeah, I'll send it. It's just, yeah, I mean, we got it all. You can print it off. It's just a PowerPoint, but it'll be good for you to have.
Are you a lender?
I manage the office downstairs, but I'm a loan officer.
You're a loan officer.
I'm
too.
licensed here and in California. I can help you.
Yeah, where in
Yeah.
California did you work?
Well, I just have my license there.
Oh, okay.
Yeah.
So maybe you know my grandmother Maria Nolan.
Yeah, I know her, man.
You do? Yeah. Oh, I was like, wow. I mean, she's worked with the company for years. Back
Oh,
when
really?
Brian Troop owned it.
Oh, cool. No,
years ago.
I'm Christopher may know her because Christopher has been out there a lot more down to those offices than I have.
Yeah, she's
so.
in Simi Valley.
Cool, very cool. Well, so yeah, anyone downstairs, there's Jamie. So there's a team in California. There's a team here. I don't know all the names of the loan officers. I should in California, but downstairs there's 4 or 5 loan officers. If they're not available, come and grab me. Say, Jim, well, help me out. I have a question or whatever. Yeah.
Are the loan offices like with Century 21?
Yeah, all of us, all of Inspiro, all of our teams are connected just with our partnership with Century 21. Yeah, they're all connected and they all are willing to help, right? And we want, the idea is to provide options for you. You may not want to use the bald guy with braces, you know, you may want to use Jamie, you know, you may want
cuter.
exactly. You may want to use Phil because he's more distinguished and older than me, you know, or God, we hired Dirk's down there, he's a younger guy. He dresses really casual and you may, hey, that he may fit with this client, you know, and that's the whole idea, right? Just to provide some options for you down there. We're all willing to help. And if someone's busy, you come in, just go to the next office, you know.
And also too, so I know when you like refer a client to, you know, like the lending side, you want to use 3, right? As I remember there was like a rule. I remember like when we were doing our classes and stuff, there's like a rule on that.
I think that's kind of an old school kind of was like kind of a professional recommendation or professional, hey, this is what you should do. It's probably a good thing to do. To be honest with you, that is not an actual law or rule.
So they're like racial covenants, you know, they're not really there anymore, but they're still written in.
Exactly. It's just one of those things that people used to do. Hey, I want to be fair. I want to send this out to 3 lenders and see who does the best job.
Yeah.
I get it. You know, it was probably a good thing to do. But I actually, we've talked about that here with like Sam Bell and you know, Rob Oakey and Matt down in the Provo office, and that is actually not a law.
Okay.
Yeah.
So it's not an actual law.
No.
Okay, because with Stringham, what we do,
Yeah,
I just did my stuff like months ago, and it was.
I know, everyone
Yeah.
thinks that because, you know, because they kind of teach that,
Yeah.
you know, it's probably,
So it's more of just like a precautionary measure,
Yeah.
more or less. That's
Right,
not-
right.
yeah, that makes sense.
right.
So I might have somebody doing a 1031. Do I need anything? Is there a specific list? Do I just refer them to you or?
That's a good question. On those 1031 exchanges, the big thing is making sure we get set up with a title company that is familiar with how those work, because that's a big deal. And you know, they have to keep that money in their trust account, and they can only keep it in there for so many days before
Right.
they buy a new one. So
So who would I need to talk to?
So first of all, probably get with North Star down there, make sure that they're set up, that they can help you with that, North Star Title, and then come and talk to us about on the mortgage side.
So get that set up with you guys first before I even
I would
talk to the client.
just make sure that we can handle it, take care of it for you. The title company can handle it, because North Star Title's down there. They're easy, they're there, that's convenient, they do a great job. If you know, or they may not do 1031 exchanges. I don't know. I've never done one with them.
What's
So
a 1031 exchange?
That's, I guess, the way I would describe it is like, you have a property, you sell it, and then you take that equity and you have so much, I think it's 120 days. I don't know.
yeah, I think
But you have so many days before you get penalized. So in other words, you have to take that money and invest it into another property. If not, then you get penalized. I guess let's say like kind of like the 401k. So they give you so many days before you get penalized, so you can invest it. If you don't invest it within that time, then you get, I think it's like 28% that they take.
Oh, wow.
Yeah, but then there's also different laws, you know, like as a single individual, you're allowed 250,000 per one time. And I think there's like 2 years, then you can redo it again. And so it's kind of like that. And that's what kind of what it said, you know, make sure that you don't screw, because you can screw the person
Yeah.
really bad. If they're depending on that equity to invest, then you can really screw them up.
Yeah, it's a big deal.
Give the sign-in sheet.
Yeah, I'm just gonna create one because, and I'll go give it to Rick.
And then,
Or,
and then all those people in the chat box, they type their name, it looks like. so
yeah,
the red does it,
I took pictures of all that, so I think I got all of them.
So he said, "What type of notes start first?" Right?
Sweet.
Cool, thanks, everyone.
Yeah.
Let's find a
So
good
where do we
solution.
sign this at?
He's a